gold is also in strong physical demand, and see, people, that's why we kind of focus on the silver market, because it gives us a much better view into these exact same actors and what they're really doing in the harder to read gold market. And what it's doing, the specs are suffering from the same spec wrong footing from the casino. And this week, following gold buying that ramped up in October, Turkish buyers have now moved aggressively into the gold market, hunting out and emptying out physical gold from two known European bank sources that we know of this week. Now, we're trying to do some more digging on this, but if they drained those two banks in Europe, you can bet your life there is more going on here. And if you think about this, it makes total sense. And there's a very good reason that every single central bank is accruing physical gold. As we have just discussed a minute ago, Basel III compliance is just in 9 weeks from now. And so while COMEX is, as we've said, Basel III compliant, it's important to understand this. The weak link is this offsetting paper hedge. It's just a paper hedge from the over-the-counter market. This enables the gaming to continue. But by the 1st of January 2022, every single ounce backing the COMEX short must be physically allocated. This ends the 50-year game and is why every central bank is buying dollar price gold. And this includes the BIS, who after January will be long dollar price gold in the FX markets to hedge its rapidly depreciating dollar exposure. Now, not that you would see it by the paper-driven action, but yes, Shane, gold is also in very strong physical demand, and we're evidencing the same unsustainable divergences between the physical and the paper markets. So very, very short term, while we expect the specs to be once more wrong-footed into these obligatory few sessions following such a large psychological operation to discount the price, and we've got the Fed due on the podium later today. And as always, the HFT, the high frequency trading bots, the game non-farm payrolls on Friday. There are two immediate, between all of these things, there are actually two very immediate underpinning bullish drivers for both paper and physical gold. And it's important to have the two drivers in place, not just the one. The first one is onerous tax measures. So the very strong US physical demand that we reported evident into our last episode picked up last Friday, the 22nd of October, and once again was confirmed by refiners each day of this week. And it confirms Swiss refineries have been busy fulfilling unusually large US physical gold orders from investors, US investors, seeking to preserve their wealth in the face of onerous new proposed tax measures. These are scary tax measures. So physical inflows of this size have not, again, been seen into the US since March 2020. These are important milestones. And the second thing that we mentioned is driving a bullish physical demand, as well as paper demand, is a perceived Fed policy error. Now, the Fed allowing inflation to overshoot its 2% target depends on their assessment that inflation is transitory. And there's a growing skepticism amongst market participants. This maybe is not the case. And uncertainty and the need to hedge ballooning risk-on positions following the plunge in real yields midweek last week is telegraphing that the Fed has very likely made a massive policy error. And the gold market is beginning to price this in an already baked rate hike gold scenario. It's already baked in, guys. So, where's the risk here? And as far as gold is concerned, this is also incentivizing COMEX-centric paper gold safe haven buying to lay off some of this risk. Now, for any gold or related silver intra-week rally, and we look at it in a weekly terms, for any rally not to be gap close. How many times have we seen it rise in the beginning of the week and get smacked back down in the end of the week? It's because it's driven by the paper market. But if you have both markets in tandem, both markets buying, it requires both of these markets to stop these gap closes and the unleveraged physical markets to step up in tandem. Now, we currently have these conditions, which is not seen since the 1970s, actually, and most recently structurally, as was evidenced into March 2020. So these two drivers alone price physical gold following the BIS mark-to-market event that we keep grinding on about, but it's so important because it prices it at least $300 under fair value. And once this wrong-footed BIS mark-to-market coiled action begins to unravel, probably after Fed today or non-farm payrolls at the latest, a very large stair-step rally will ensue. And it's going to be physically driven. And this may well overshoot current gold market resistance, which is, we know, 1830, 1835. That's everyone's looking at the same resistance level. But we do not count out the BIS. We can see a possible overshoot, but we don't count out the BIS bringing price back to this level on any overshoot into the end of November. So we have to be careful here. Now, obviously, we'll provide an update on this well ahead of this in our next episode.
Andy, that is awesome. Lots of that's why I love this. You know, I get all fired up when I hear what's happening. I'm hearing it in real time as well. But here goes. You know, buy physical. I'm getting a lot of calls on this, and really, we want to thank everyone in the community for helping other people also understand the difference. What Andy affectionately calls the casino paper and gold and silver markets, and the actual physical gold and physical silver markets. They are not the same. And so there you have it, everyone. That's all we have for you today. Another fascinating episode of Live from the Vault. Please help spread the word. Share the channel. Hit the like button. Hit that subscribe button and click on the bell if you want to be notified as these episodes go live. And with that, we'll see you next time on Live from the Vault. See you then.